value of money is also part of the introduction, but we shall not look at it. We shall first do the first part, then we skip time value of money. We do personal finance. We do financing decision. Then we also do working capital decision, which those things mostly have theory parts. It has maybe graphs. Those ones I will have to illustrate. You'll understand those, and maybe working capital has some calculation somewhere regarding the cash budget. But all the other things, I think they are theory. So when you come, we shall do calculations, because calculations are better when we are face to face. But you need to be with, you need to make notes. You need to come and study and make notes, because I'm expecting many people, but I see you're only 30. So should we start? Are you getting me? Just try inviting your friends to join in. You can tell me in the chat if you're getting me so that we can start. Brenda is getting me. Okay. Looks like everyone is getting me. So let's start. So we are going to basically introduce ourselves to financial management, and that's the topic, the first topic, where we are going to try and appreciate a number of concepts in financial management that will bring us to the importance of financial management, different functions of financial management, and the different aspects like the risk and return relationship, then also the main objectives of the firm, which are basically profit maximization and wealth maximization. So we shall look at those during the introductory part of the course. Hope you're following with me on the screen, on the shared screen. Firstly, finance. What do you understand when someone says finance? When we hear someone saying of finance, what do you understand? Before even going into financial management. Shanita is saying money. Shanita is saying for her, whenever she hears finance somewhere, what comes into her mind is money. Any other person? Anything you understand when you hear someone talking of finance? Someone can say, I don't have finances. Some people talk of financial institutions. Some people talk of a financial manager. Some people talk of a financial department, maybe in an organization. But when you hear anything attached to finance, what comes into mind? Rodney is saying money and budgeting. Judith is saying income and expenses. Yeah, so I think that's enough. So meaning we have an idea of what finance is associated to. So this it shouldn't be something hard, because it's not so very new. We all understand at least something regarding finance. So when we talk of finance, we talk of basically an art and science of managing money. It can either be an art or science. It is an art because it involves a number of qualitative factors, and it's more of a science because more of it is the quantitative factors rotating around money. So when you're going to do any decision regarding money, one, you consider qualitative factors. How important is this thing maybe you're going to spend? How important is this thing that I'm going to spend on to me? Maybe it's going to increase your health or something. But also you also involve the quantitative factors, whereby you analyze how much should I spend? Do I really afford it? Such aspects. So when you're trying to do anything around money, you're going to bring in qualitative but also quantitative factors, and that makes it an art or even a science. So the term financial management, in its broad sense, brings in a lot of aspects. These aspects might be personal finance, which is basically finance on the personal level. It brings in also aspects of managerial finance, whereby you can manage finance, or you can have financial management at a management level. Maybe it's an organization and there is the Department of Finance, and maybe you're heading it. Then we also talk about corporate finance, which is in form of corporations. Now this is in line with the organizations, different corporations, different firms. But also on a business basis, we can also talk of finance on a business basis, whether it's a good business, whether it's a bad business, whether we're getting profits or not, things like those. Some of you might maybe want to invest money somewhere. You'll call your friend. You're like, I want to rent a canteen in the university. So your friend can tell you that that's good business. You can put your finances into, and you'll get them back. So we can look at finance on a business basis. But basically, financial management refers to the different actions or different decisions that you make along when you are trying to plan, acquire, allocate, and control financial matters. Hope you get that. You are trying to, when you are trying to acquire, when you're trying to plan, when you're trying to allocate, when you're trying to control financial matters, there are different actions and decisions you undertake. And that's what we are calling financial management. That's what we are calling financial management. Meaning financial management doesn't only stop at planning to acquire funds, but you also go into how do you acquire them, mainly where do you get those finances from, how do you allocate them after acquiring them, and then where you have allocated those finances, how are you maybe going to control them? If it's a business venture, how are you going to control that business to make sure that the purpose for which those finances were deployed is achieved? And that's what we basically call financial management. So it basically rotates around financial matters. It basically rotates about funds, financial resources, as you understand it, as you understand money as a resource. So that's where we basically that's how we bring out. So from the core beginning of financial management, from the core beginning when you start to acquire finances, to the last part when you are trying to control maybe something into which you have put those finances, that's what we basically call financial management. So it does everything rotating with money, from acquiring it, allocating it, monitoring it, and maybe getting the outcome. So if we've understood financial management, then we should be able to raise some of the hypotheses, meaning it's important in a certain way. It can be important on a corporate level, it can be important on a business level, it can also be important on a personal level, and it can also be important on a managerial level. So, what do you think are some of the importances of financial management? I want us to follow together. I don't want to be alone in class. So, please be ready to contribute, understand, and contribute something. You don't have to say anything. When you need to explain, maybe that's when you can raise up your hand. But for contributing or what, or maybe if you have a broad question that you think if you type it won't come out very well, that's when you can raise up your hand. But maybe right now for the contribution, you can type something. So what do you think is the importance of finance? Someone is giving decision making. Anything else? Anything else? Decision making. That financial management is important in decision making. Maybe those decisions regarding finances. Kastaija, I don't know why my sound is not good to you, but looks like other people are getting me well, so you should try to adjust your network maybe and see. Judith is saying it helps in knowing if the business is making profits or losses. Yes, that is a business evaluation. And someone else is also saying it helps to control finance and profits of the organization. That is controlling. Then accountability. Then provides pathways to attain goals and objectives. It helps in planning, facilitate investment, for investment decision. Yes, so acquiring funds. Yeah, so people are following up. Those are very impressive answers. So let's keep following together. Those are very impressive answers. So so you'll find that some of the answers you've given are embedded in here. One, we are saying so someone gave someone gave a point about decisions. Now you see, whenever you give, let me say, you're in a paper and you give a point about decisions, mostly in these, like in financial management, you find that you're taking almost all your points in there. Because, for instance, when I can talk of some of the importances you talked about, allocating funds, still that's a decision. That's decision making. Someone talked of raising funds, which is also a decision in there, isn't it? So you find that when you give decision making as a point on its own, you have embedded into a lot of things in there. So it's better maybe you try to look at each particular decision on its own, and how financial management helps in making such a decision. For instance, here we can say it helps in long-term investment decision. So look at look at maybe a corporation that is trying to acquire funds for investment in their organization. They will basically use financial. Well, they use financial management. So they use financial management. You're trying to analyze this project. You cannot put your money into a big business or a big project before you analyze it. I gave you an example, for instance, the Express Highway. It's a very big project. A lot of government money was put there. So you need financial management for you to take up such a decision, because you will first analyze it, look at it, is it really viable? So here we apply, of course, different techniques, such as the net present value, which will show us the expected cash flows after discounting them, and then we subtract what we had invested into it. So we look at how much are we going to get from that investment throughout its lifetime. If it's a machine we have bought and that machine is going to work for the company for the 5 years, we look at how much will that machine be generating per year. then we bring in the aspect of the present value. We shall look at those things under time value of money, whereby you try now to discount those cash flows of the 5 years to represent their present worth. Then after we try to reduce now the initial outlay, that will give us whether we should invest into that project or not. So you will see that financial management will help us to make such investment decisions that are in on a long-term basis. Then it is used in evaluating alternative sources of finance. Someone talked about it, raising funds, whereby you have different sources of finance. Remember the other time we said that in most sources we have, some of them are debt and others are equity. So evaluating the best alternative, and in most cases the best alternative is the cheapest source of finance. That's what we take as the best alternative. So to evaluate those sources and understand which one is better for me, we use financial management. So here we use tools like loan amortization, whereby you go to a bank, you want a loan, you amortize that loan. You know how much will you paying per annum at a particular interest rate. So that is a tool of financial management, loan amortization. Look at a loan, amortize it, understand how much will you be paying at a particular interest rate per annum. Then for how long will you pay that loan? Then decide, should I take up the loan or should I leave it? If you have another loan option, also amortize that. Now you have two options. You have amortized, you know each how much does it require you to pay. You take a decision. So you take a decision whether to get this loan or to get the other. You take a decision whether to use a loan or to use some equity. You sell some shares. So there we apply different tools of financial management. Then also talk about helps in dividend policy. Remember we said when you have an organization at the end of a particular financial year, you will decide whether to take all the profits from that firm and give those profits to shareholders as dividends. Because we said dividend is payment to shareholders. So you can decide to give all the money to shareholders. You can decide to all the profits to shareholders. You can decide to retain some profits and give some to shareholders, invest what you have retained. But still you can also, depending on the kind of shareholders, tell them that, this year we have made 20 billion, but we are retaining all this money, we reinvest it so that with time, our business will grow and we shall be able to make more. So in doing so, in taking such a decision, you apply different tools of financial management. Then also we talk of assessing the liquidity position of the firm. So liquidity position, in this case, we are meaning the ability of the firm to take care of its financial obligations as and when they fall due. Liquidity, the ability of the firm to take care of its financial obligations as and when they fall due. So different tools of financial management will help to show us that this firm will be able to pay its loans, it will be able to pay its creditors, it will be able to pay for raw materials when they need them. So assessing that liquidity position, that position that we shall be able to cater for our resources when we need them, or our obligations when they fall due, to get to know whether we are in a good liquidity position or not, we use different tools. For instance, the current ratios. So the current ratio, which is basically we get our current assets out of current liabilities. So the ratio will be able to show us such a liquidity position. So then the other one is financial management is used in to take the corrective control where the firm is not performing well. We use different techniques to control or to correct some something that's not going well into the farm. Maybe we invested into a certain product. We introduce a product line. Maybe you're managing a company like Coca-Cola. You introduce a certain energy drink. So financial management in that case will be as an indicator that maybe this drink will not perform since finances maybe are not coming out well. So we take a certain corrective action of maybe withdrawing that product or evaluating or maybe trying to make it better. But an indicator that will show us that we need to take a certain action to correct that maybe product or deficiency in management or anywhere. We shall use different financial management tools. And also it helps in formulating the credit policy. It helps in formulating the credit policy. So this is basically the policy at which the company gives credit maybe to its debtors. So that's the credit policy. It involves things like the collection period. It involves things like the credit term. It involves things like the credit period. That if someone comes and takes a car from my bond, how long should I give him before he returns that car? Hope you're getting it. If someone maybe we have a software company. If someone if another big company maybe takes software on credit, how long will I take to collect money from him? Which policy should I use? What if he doesn't pay? What happens? So we use different financial tools to determine such circumstances. Then also it helps in determining the efficiency with which the farm is being managed. Of course, that is like measuring performance. So it depends whether the farm is efficient or not, isn't it? You want to promote your product, you put it into a certain promotion or marketing line, and then you evaluate whether it's performing. You look at how much you put into that. Someone's audio is on. Please turn off your audio. We are getting feedback and interrupted. Then also it helps to determine profitability position of the business using tools like the profitability ratio. Look at the business, whether it's profitable or not, whether it's performing or not. So to understand whether our business is profitable, we use those such ratios, profitability ratios and others, which is a tool of financial management. Then also evaluating the leverage position of the firm. So financial leverage is basically employing debt into your firm. So to evaluate the leverage position, that is basically to evaluate how leveraged the firm is. How much debt have you employed vis-a-vis equity? And to know that position, we use different tools. For instance, the leverage ratios will help us know the leverage position. And those tools, by the way, don't stop on showing us the position. They also show us whether it's a good position or bad, and they also have show us which one to take. That when I get this ratio, I do this. So different circumstances. So financial management basically is important as long as something is to do with money. You find it with different importances. Kangu Medidas, kindly put off your okay. So hope we are following through. In between, you put it so that when we get time to check, we can answer your question. So after the importance, we go to the financial management scope. So you will find it indicate differently into different books. So we have financial management scope, which is the financial management functions, and sometimes you call them financial management decisions. They can be functions. It can be the scope, like what is embedded into financial management. We can also call it the functions or decisions. So last time when I was with you, we talked of these decisions when I was introducing the course. I expect you to be having an idea. So if anyone remembers any of the decisions, you can tell us. If anyone remembers any of the financial of the decisions that we basically base onto, or the functions of the financial management, or what is embedded into the scope of financial management, you can tell us. Sharifa is saying investment decision, which is right. Working capital, Brian. Which one else? Who's saying something else? Those are two. They are supposed to be four. Dividend decision, yes, Timothy. Which one else? Dividend, yes. Only one is remaining. No, finances. Finance is not part of them. Finance is not part of them. It is called the financing decision. It's not finance decision, it's financing decision. Hope you're getting it. Financing decision. Where to get money from. Financing, not necessarily finance as a whole. Long-term asset decision, yes. Long-term asset management decision, which is the one they mentioned first as investment decision. So we say that every financial manager and organization is faced with a number of questions. The first one is, what long-term investment decisions should the firm take on? Because every firm, for it to grow, it needs long-term assets. That's why some scholars like the Modigliani and Mira in the theory, they argue that a firm's value is indicated by its asset mix. So that when we want to see how valuable is a certain firm, we look at its assets. For instance, a firm maybe that has a lot of buildings, land, what are those long-term assets, we can decide that that firm is valuable as compared to the firm that has less assets. So meaning for a firm to grow, it needs such assets. So you'll have such questions. What long-term investment should the firm take on? From where should the funds be raised? How will the firm manage the day-to-day cash? And how will the earnings be apportioned? So you start with a long-term. How will I get a building for my company? How will I get land for my company? Then you also look at, yes, if I want land, how will I finance that money? Where will the money come from for that land? Which is basically now the financing decision. And maybe if you already have the land and you're working, you need things like fuel, you need things like pay for electricity. So you'll ask yourselves, how will I manage the day-to-day operations of my business? So you have the land now, you're able to manage the day-to-day, you have different sources of funds, you can get from this loan, you can get from this bank, and different. Now you at the end of the period, you're going to make profits. So you're like, how will I manage these profits? Should I just take all the money from the business, or should I maybe now invest some back to the business? So those are different questions we come with when we are trying to manage finances. So those questions can be answered with the four main decisions of financial management. The first one being the investment decision, which is the decision to invest in long-term assets and business assets. The second one being the financing decision, which is the acquisition of long-term and short-term funds of the firm. Working capital decision, which is the decision regarding the level of investment in the short-term assets of the farm, which short-term assets or short-term capacity help to run the long-term. Long-term, look at a building or a machine. To be in that building, you need power there. That is short-term, because you're going maybe to pay power per month. So such things. So the assets to run it, the assets to pay for that power are what we call short-term assets, isn't it? And now the power is in a building, which is a long-term asset. So for you to run the long-term assets, to make the long-term assets operational, to make money for you, you will need what we call the short-term assets. So basically, short-term assets help to run the operations of the long-term assets. Or some books will find them talking of the short-term capacity. That working capital is the short-term capacity used to run the long-term capacity of the farm. So depending on which situation. And then the other thing we talk of the dividend decision, which is basically the decision as to whether earnings of the farm should be paid out as dividends or retained as earnings. So we have 3 decisions we can take after maybe at the end of a financial period. We can decide to give out the profits of the farm as dividends. We can decide to retain them. We can also decide to retain some and give some as dividends. So such a decision, you also make it. So these different decisions, we shall look at them broadly, each on its own, in their broad sense. In fact, each decision is a topic, but also each decision can be asked. Maybe someone asks you, write short notes about the 4 decisions of financial management, and he gives, and maybe each decision has 5 marks. So you should know, that's why I said you should be able to make your own notes. So from what I've been explaining, you should be able to write something that gives you 5 marks, so that now it becomes, you can earn such mark, because now if such a question comes, then it's like the easiest in the whole paper, and the easiest questions are the better questions to answer. So this is everything I've been saying about financing decision that is concerned with the assessment of various sources of funds. So we look at different sources of funds at our disposal, evaluate them and see which one to take. You want 50,000 to use. You have 2 friends. You have a friend, maybe is a girl, maybe she's called Brenda. You have a friend who is a guy, maybe he's called Moses. So Moses tells you, I'm giving you 50,000. If you're giving it back to me next week, you'll pay me 60,000. But also Brenda tells you, yes, I'm giving you the 50,000, but you'll pay me how much? 10,000. You will pay me back 70,000. Sorry about that. So so you look at different sources of funds, which one is expensive of the 2, and then maybe you take the cheaper one, because you don't want no one wants to take up an expensive source of fund, maybe an expensive aspect in his business. So there are some terms I want us to understand here in the financing decision or the capital structure decision. One term is the capital structure itself, because it's called financing decision, and we are saying that financing is associated with the assessment of various sources of funds to determine the cost-effective source of fund. Determine the cheaper one, you take up that one. That's one. But also, why is it called the capital structure decision? What is basically capital structure? Now, remember we said that capital structure is the composition of the long-term debt and equity. We are trying to raise funds. We say the most popular sources we have is either debt or equity. A debt, like you get a loan, or equity, you sell shares and maybe use your money in the business. Now, Now we are saying that capital structure, which is not capital structure is different from financial structure. So capital structure is a composition of long-term debt and equity. Maybe you have 60% long-term debt and 40% equity, which is the capital structure. Now, the financial structure is when you have short-term debt, long-term debt, and equity. You're getting it. When we just say debt to equity, and our debt has short-term debt, long-term debt, and equity, that is a financial structure. But for the capital structure, which is basically what we are basing on to here, call it the capital structure decision, that's long-term debt and equity. When we bring in short-term debt, it becomes financial structure. Financial structure, long-term debt, short-term debt, and equity. Capital structure, long-term debt, and equity. To equity, actually. So, so funds can be raised from equity, as I've told you, or from the which is maybe the owners, shareholders, or maybe it's your own business, you put in money, or it can be from the outside, which is in most cases can be debt. And that mixture now, what we've been talking about, whether it's financial structure, what part capital structure, it brings out a certain mixture which we are calling the financing mix. So someone is saying I'm going too fast. I don't know where I've not understood, because I'm repeating a lot of these things and I don't want you to not understand them. So we are saying that the financing decision is basically concerned with the assessment of different sources of funds we are going to put into the business. And these sources of funds in most cases are either equity or debt. And debt can either be long-term or short-term. Now, if the sources of our funds compose short-term debt, long-term debt, and equity, that composition, we call it the financial structure. However, if we only have long-term debt and equity, we don't have short-term debt. When we have long-term debt and equity, that is called the capital structure. And now that composition will bring us to something like debt to equity, because now we have equity and debt. So you have something like debt to equity. That's our ratio. Hope you now write ratios. You have debt to equity. So such a composition, if you can read through there, they are saying that so such a composition, are calling it a financing mix. A financing mix. The mixture of different financing sources brings us to a financing mix. If you have one source, that is not a mix, but when you bring them together, that's a mix. Now, how we write them, you're seeing it there, that this may be in the second paragraph when it's almost ending. This may be in the proportion of 80% equity and 20% debt, or 60% equity and 40% debt. So depending on which percentage, you can have 40% equity, 60% debt, or 70% debt, 40% is 30% equity. So adding up, so it's always written like that, debt to equity. Now, after that, we bring in now the concept of the financing risk. Because you have added up different sources of finance to come up with a certain amount of money for you to invest, you're going to come up to bring now what we are calling the financing risk. The business is going to face what we call the financing risk, which is the risk faced by a business due to adoption of different sources of funds into its financing. Debt will come with its risks. Equity will maybe come also with its risks, and we end up with what we are calling now the financing risk. Can equity be less than debt? Yes, that's possible. It's possible. It can be more debt or equity or debt. It's very possible. But also, your debt to equity ratio will show us now the position of the firm. Because if a firm has, let me say, 80% debt and 20% equity, that might scare away some prospect investors. If you wanted to buy shares and realize that this company you're buying shares from already has 20% debt, 80% debt, and equity is only 20%, you might be scared. So those are some of the indicators we are talking of that show us now the financial position of this firm. Hope you're getting it now. Someone asked that question, now you're with me, I get you. So now you're getting what we are talking of now, some indicators in financial management that can help us to show now the financial position of the firm. Someone is using a lot of debt compared to equity. So now we go into details. Is this debt really sustainable? Will he be able to pay it? How has he been paying before? Will he be able to pay the other debt? So now we know whether his firm is in a good position or not, but that can happen. So we are saying that the someone has some funny voice. So we are saying that now this financing risk, we've defined it here as being the likelihood of viability of return as a result of method of financing used by the firm. Your financing used by the firm will affect the likelihood, or will affect the returns. So that likelihood that returns might change because we have used debt, and debt has interest. So meaning some of the profits we are going to get will be paying interest. So that is the risk we are talking of. That the likelihood that my returns will change because of a certain financing method I have used. That's what now we are calling a financing risk. Now, when you have a mixture of those different sources, you have debt, you have equity, and you have created what we are calling the financing mix, it will result into what we are calling leverage. What we are calling leverage. So because you have debt into your company, leverage is, whenever you hear the word leverage, that's associated with debt. A company that is highly levered, a company that is highly indebted. I want you to understand the things very well, because now we've talked of like 6 concepts that you should understand. And if you've been writing down something, then you should be knowing them. So we are saying that the financing leverage therefore refers to the use of debt as a source of financing alongside equity. Whenever you employ debt in your financing, that we say that company is financially levered. Whenever you, but you see, I've spent about 30 minutes on one slide, and people are saying I'm very speedy. Some people are not listening in well. So we are saying financing funds in the firm. So you have different financing sources. You can decide to use only your money in the business. Just issue out shares and use only equity money from shareholders. But when you bring in debt in financing, now that's what we are calling the financing leverage. Hope you're getting me. Whenever you bring in debt in your financing or as a source of finance into your finances, into your company, that's what we call now the financing leverage. That's why you are defining it as the use of debt as a source of financing alongside equity funds. So hope that's it. So because you have used debt, you have to pay you have some different obligations, like payment of interest and also payment of that principal, because you have to pay back that money. So that will bring about some financing. It will result into some financing risk. So basically, we have talked of here on the financing decision. We have talked of financing decision itself, which we are saying that it's the decision or assessment of various sources of funds to use in your company. And we are saying that these sources will result into what we call the capital structure, which is basically the composition of long-term debt and equity. And then this structure will create what we call the asset mix, which is basically the mix of the financing mix, rather, which is basically the mix of different sources of funding into your business. And because you have mixed different sources of funding, you will face what we are calling the financing risk. So the financing risk, which we are saying that is the likelihood of changing in your returns as a result of using different financing sources into your firm, and as a result of the financing method you have used. So we are saying that this mix will also bring about what we are calling the financing leverage. That is when you have used some debt into financing. Hope you're following with me. So according to what we've been saying, if we can look at an illustration here, this is just a simple calculation to illustrate the financing risk, which is basically trying to show us that your returns will change depending on the source of method of finance we have used. So if we can read through the question, let's read through. Assuming a company has debt of 100 million, a company gets a debt. Assuming a company gets a debt of 100 million, that's company A. Another company gets a debt of 300 million, and another company gets a debt of 500 million, respectively, at an interest rate of 100% per annum. So the interest rate at which these debts are being advanced is 10%, rather, beg your pardon, per annum. And this company is in a tax bracket of 50% corporate tax. So the question is, determine the variability in the net earnings if earnings before tax is 400 million. So all the three companies, their earnings before tax is 400 million. So that's what we are starting off. You have four companies. You have company A, company B, and company C. All their profits are 400 million, isn't it? But now, these companies have different sources have the same sources of funds, but their composition is different. One company has used 100 M as its debt. Another one has used 300 M, another one has used 500 M. So we are going to see which company will have more returns compared to the other at the end of it all. Hope you're following with me. So they have all made the same profits, but they have to cater for their loans, isn't it? So if you can look at the solution down here, you have earnings, you have company A, B, and C. You have earnings EBIT, which is earnings before we reduce interest and tax. Each profit is 400 million before interest and tax. 400, 400, 400. You can follow through. Then we reduce interest. We said, according to the question, interest is 10%, isn't it? So the first one got a debt of 100 million, so it's interest. That line for interest moved, so I hope you can see it well. It moved. This 10 is supposed to be under farm. Okay, I'll correct that, but I think it has moved because of the presentation, because it was fine. So meaning interest for company A will be 10 million, since it got 100 million. Interest for company B will be 30 million, and interest for company C will be 50 million. So after reducing interest, we get earnings before tax. So earnings before tax for company A is 390, B is 370, and company C is 350. After that, now we reduce tax. So the companies are in a 50% tax bracket. Meaning tax will be 50%. So in this case, Farm A is paying a tax of 195, Farm B is paying a tax of 180, and Farm C is paying a tax of 175. So earnings after tax will be, so you see, these companies had the same profit earnings before they reduce interest and tax. But now, because they use different financing options, some of them had a lot of debt and some of them had less debt. At the end of it all, those companies
inquiring about this figure of the tax.
Tax is 50% of earnings before tax. You see, they are saying in the question that the company 50% corporation tax bracket. So you get 50% of 390, 50% of 370, and 50% of 350. And that will be our tax. So the tax, you reduce it from earnings before tax, you'll end up with earnings after tax. Now look, so you compare the values up, 400, 400, 500, they all had the same profits. But because some of them used a lot of debt as compared to others, their earnings at the end of it all changed, earnings after tax. Those that had less debt ended up with a lot of earnings compared to those that had a loss of debt. So that's the financing risk we are talking about. That when you bring in, when you decide to acquire a debt in your company, the risk will depend on to how much debt you have acquired. If your company, you're subjected your company to less debt, then there will be less risk as compared to someone else. So depending on the financing method you'll have used, will be the outcome of your will be the outcome of your earnings. Then after that, we go to the capital budgeting decision. We are done with financing decision. Here we are trying to answer the question of which long-term assets should we acquire, because you are creating a long-term capacity of the firm, that long-term growth. Have a company. Should I acquire a building? Should I buy a car? Should I get a machinery? Should I get new software? So so that's basically what is concerned with a long-term decision. Now, remember the other time we said, because of the financing mix you have got, because of the financing decision you have taken, you get what we call the financing mix. But now here we are getting what we are calling the asset mix. Because you have decided to invest in two different assets, and these assets will give you what we are calling the asset mix, which is the different types of assets you have invested into. And the choice of these assets will result into what we call the business risk. Will shape will direct your company to a certain business risk. For the financing, it is financing risk. For capital budgeting, we are talking of now a business risk. Now, We define business risk as the likelihood of variability in return as a result of the nature of the business that the firm is undertaking. The likelihood of variability in return as a result of the nature of the business that the firm has undertaken. The nature of a business that you have undertaken will affect or might affect your return in the other way or around. So the likelihood that your returns might reduce is what we are calling the business risk. So the likelihood that your returns might change as a result of that business is what we are calling the business risk. So a firm that, let me say Umeme, might not have the same business risk as MOBS. So it depends. So a manufacturing firm cannot have the same business risk as a service firm. MTN cannot have the same risk as maybe as a certain bank, as let me say Stanbic Bank. So difference, because you're involved in different businesses, your businesses will face different risks, and those risks are what we are calling the business risk. Now, those risks are brought about by the different assets you have invested into, which is the asset mix, isn't it? A bank might decide to invest more into let me say like MOBS might decide to invest more into buildings, those such long-term assets. But MTN might decide to invest more in software, and maybe it has less of buildings and part, but it has software, isn't it? So they will face different risks. So we are saying that two risks, the financing risk that we talked about and the business risks that we talked about, are very important, and they bring out very well the importance or the function of finance to a firm, isn't it? You don't want to, you want to know, to expose your company to a financing risk that you understand, or a business risk that you understand, then you'll need financial management. Then now we can talk of working capital management decision. Determination, the level of investment into the short-term assets. How they should be invested, and how the level of investment and how these investments should be financed. So basically here we talk of the short-term assets of a firm. Short-term assets have different categories, but we mainly talk of four. One, we have debtors, which is which are customers that the firm expects to be paid by those customers. So customers that have the debt of the firm is what we are calling debtors, or trade receivables. Then we have inventory, where we talk of things like stock and the others, so short term. So then we also talk of things like, then we also talk of cash, which is the most liquid asset now, which is the most biggest component here. Then we also talk of trade payables, or those are liabilities now. But now to get the net working capital, remember we get current assets minus current liabilities. So meaning when you're looking at working capital, you also need to look at now the liabilities that you will need to do what? To pay. So we are trying to make investment decisions regarding inventory, regarding debtors, regarding cash. How much cash should we have? Will it be enough for the day-to-day running of the business? How much debts should we give? Or maybe we have given a lot of debts, let's stop. Or maybe a lot of people have our debts, so this person has taken loan without paying, let's not pay him. So all those decisions regarding the day-to-day operations of the firm or regarding the daily obligations of the firm are what we are calling working capital. Those are what we are calling the working capital management decisions or liquidity decision. We call them liquidity decisions because of the other definition of liquidity we talked about, the ability of the firm to take care of its daily obligations as and when they fall due. So you want to avoid you failing to pay for your obligations. So in managing working capital, in most cases, we have two things. We have what we call profitability, and then we have what we call liquidity, isn't it? So liquidity means you have to be, for example, with a lot of cash, so that if you have to pay the supply, you pay it. We need electricity, you pay it. We need this, you pay it. Liquidity. But remember, when you're holding a lot of cash in your company, that is when you have a lot of liquidity, this money is not invested anywhere, isn't it? So you're not achieving profits onto it. So meaning you achieve liquidity at the expense of profitability. The money that you would have invested, you're just keeping it into the company so that you can pay obligations when they fall due. So you're not achieving profitability. Now, some managers, for instance, the ones we call risk takers, for them, they will invest a lot of money and then take a risk. That's why we are calling them risk takers. They're like, someone, you're like, I will deal with the creditors, but let me first invest this money. So those are the risk takers, isn't it? Joan gave you her money. You know you're supposed to pay her next week, but you're like, let me first invest this money somewhere, isn't it? So someone who fears risk will not invest that money. He will have liquidity, he will have his money around, so that anytime Joan calls him and is like, give me my money, he will pay him there and then. But now if you want profitability, that's someone who fears risk. If you don't fear risk, you will invest that money. When she calls, now you deal with it there and then. So when we are trying to manage working capital, that's why now we come up with those two aspects now, profitability and liquidity, which we can achieve one at the expense of the other. Then the other aspect is dividend decision. Remember, we said dividend is basically payment to shareholders, and we said that most shareholders who invest in your business will assess that business according to the dividend maybe you give. Some shareholders take businesses that give a lot of dividend to be more profitable than the others. Then we also said that when you have at the end of the financial year, you have three main decisions you can take: investing all the money, giving all the money as dividend, or investing some and giving some as dividend. And now what you are investing back is what we are calling retained earnings. We should get all these aspects because we are going to use them. We are going to use them in different illustrations, different calculations, and also explanations, because we are going to look at these aspects as topics on their own. So those terms, retained earnings, now we should be knowing what it means by now. So that's it with the dividend decision. So those are the four major decisions which cover the scope of finance, what we call the financing function. However, there are some other functions that come in on a day-to-day basis, maybe when you're in the finance office, like acting as a treasurer of the business, record keeping and production of periodic reports, managing daily cash receipts and payments, banking of surplus cash. So you will see that these ones, most of them fall into the other major four. So these are other routines. So most of our question can come in that way, that you give other routine functions of finance apart from the four major ones. So that's when now you talk of these ones now. That's when you talk of these ones. One, acting as a treasurer of the business. Have to be knowing how much the business is getting, when, how much is it investing where, then also record keeping and production of credit reports. Those are credit financial reports. So some of these roles mainly are done by accountants. And if you did financial accounting, because I told you when I was introducing the course, but at this level, we expect you to have covered accounting somewhere before going into financial management. Because now financial management is like now the end of accounting. Accountants get instructions from financial managers. It's a financial manager maybe to sign, you release this money. That's why you'll find in most companies, the CEO is also the financial manager, or you find they have the deputy CEO in charge of finance, something like that. Some of you who went to schools, remember there are schools where you find deputy in charge of academics, and then deputy in charge of finance and administration. So those functions like the banking, surplus cash balances and cash receipts, the financial analysis and planning, some of those aspects you find that they are done by the accountants, but of course under the financing. So when you're looking at the daily routines, now the functions that he does this and this as a financial manager, those are the ones we always tackle. So after covering the importance of financial management, and we covered different financial management decisions, we look at the roles. You should be able to differentiate these things, because you might be asked the other and then you answer the other one. So the role of financial manager, one, we talk of identification of sources of finance. These ones I will not need to explain a lot because you have looked at most of these things before. Because when someone says identification of sources of finance, we've talked about some sources of finance as debt, we've talked about equity, we've talked about, so you should be able to know those. Then we also talked about what comes about, the financing mix. Then also the allocation of funds, that is in line with investment decision. Evaluate different ventures that you have. Look at the most profitable venture or investment and take on that. Then we have coordinating with other departments or divisions. Now this is the major role that I wanted to bring out very well when they talk of coordinating with other departments or divisions. Now, remember different departments. Companies always have different departments. There's a department of accounting. There is the human resource department, marketing. You have and all other departments. But you'll find that in some way or the other, all departments will either be making money or they will need money to do their operations. So that's why, as a financial manager, one of the major financing role, or the roles of a financial manager or treasurer, is coordinating with other departments, try to bring them together. What's the need of this department? What's the need of the other? Isn't it? I gave you an example last time that when a human resource manager is going to do what? To maybe bring other employees, he will need what we call the statement of the financial implications. Human resource manager wants to recruit, maybe bring other workers. So you will have to first look at the statement of the financial implications into that firm, isn't it? Then no, shall we be able to pay these people? How much are we going to use in the recruitment process? So all that you will need an assistant of a financial manager. Now, for instance, for your case, when you're working for maybe a software company, you want to develop a new software or a new product for that company, you will need maybe some funding. Then you also need to know whether that software will help the company or not. Financially, what will be the cash flows generated from such a project and the likes. Then also talk of dealing with the financial and capital markets. Those ones are like because now financial markets or capital markets, that's where financial instruments are sold. So you'll need to deal with them either for investment or as a source of funds, isn't it? So if I need money as a company, you will need to be aware of maybe different interest rates of different companies. You need to be aware of different loan terms of different companies. At any time my company needs some loan, this bank will give me maybe a less interest compared to another one. So you need such circumstances. But you also need them for investment. For investment, like different companies that maybe in treasury bills, maybe buying a bond for your company. So such instances. But also even by the way issuing a bond, because some companies issue what we call a corporate bond. A company wants money, it doesn't necessarily go to a bank to get a loan, but it issues a bond. A bond is basically a debt instrument that in most cases goes beyond a year, of which the bondholder earns an interest as so the company uses it as a debt instrument. You have a company sells a document to you, then you buy it as an individual, you give it money, it uses that money into investment, then it pays you back at maturity. But you as the person who has given the company money, what you hold is a bond, and then you also get periodic interest until maturity, and then after the maturity you get back your money, but now your earning is that interest you get. So so for the company to issue out a bond, company needs money, you need to sell a bond now for those companies that are registered on the Uganda Security Exchange. Talk of companies like which companies register? Talk of companies like Umeme. So like they issue out maybe shares. You want to raise some money, you issue out shares. So as a financial manager, you should be conversant with different financial markets. Then also managing risk. We have talked about different risks. We've talked about the business risk. We talked about the financing risk. So financial management will help you to manage these risks. Are unavoidable because you have to finance your business, meaning you're going to get the financing risk. So you can't avoid that. So you need to be knowing how to deal with such a risk when it comes about. Then you have management of cash, which is basically a major role. Raising cash, collection. You have people, maybe debtors, you demand money, collecting that money, and maybe disbursement. When should you give money? What I told you, different operations. In fact, in accounting, they consult more the financial managers. The financial managers append their signatures. Maybe let's buy this, you have to sign there. So you have to manage cash in that line. Not necessarily that you're counting it as the accountants. Because what we do here in accountants, what they do is, in most cases, maybe chief accountants, which are also more like financial managers, for their offices and wait for money that is coming to the company and maybe make payments that are coming. But as a financial manager, you're on top there, looking for that money. Accountant is waiting for money to come to the company. For you're looking for that money, how will it come? which sources, how will I get it, isn't it? Then after now you have got it, how will I allocate it? Where should I put this money? So in that line, you'll find that you're now doing that cash management role. Our time is fast spent, but a little bit here. We shall pass through it more next time. But basically, is the objectives of the farm. The next time we shall do objective of the farm. Then we also do after objective we do the concept of risk and return. But maybe just a little bit on the objective of the farm. Different organizations have different objectives. But the main ones that we always tackle here in finance, one is profit maximization, and another one is wealth maximization. So you should be able to understand. Just go and read through that. Just go and read about that. Just go and read about that. Read about wealth maximization and profit maximization, and read about their criticisms. In most cases, an advantage of the other is the criticism of another. And of course, such things are criticized with their, in most cases, assumptions. So and their treatment. So that's what you're supposed to read about. So next time we shall talk about the objective of the farm. We talk about the risk and return relationship. Then after that, we someone has switched off his microphone. We are still Okelo Emmanuel Okwi. Go and read about those things. Next time we shall cover the objectives of the farm, we cover the risk and return relationship, and we also introduce another topic, because when we cover that, we shall have covered the introduction theory of financial management. Then we shall be remaining with some calculations that we shall tackle when you come. Because I've told you, and those who are not around when we are starting, we said we made a decision that let's start with the theory part. So each topic we are going to only tackle the theory part. Then when you come, so your topics may be a bit disorganized, but you should bear with us. So we shall tackle all the theory part in different theory parts and different topics. Then when you come face to face, hope you saw the first timetable, we do calculations. But when we are doing those calculations, you should be able to remember the theory. Because I told you last time that finance is not necessarily as accounting, but also theory helps us interpret the figures we get after calculating. Any question? If you have any question, you can raise up your hand or talk about it. Do we have anyone from Ginger? Do we have anyone from Ginger? Do we have anyone from Ginger campus? Someone is saying where should you read? I said you read about the two major objectives of the farm: profit maximization. Mary, you're shouting for us. Mary? I said you read about the two major objectives of the farm: profit maximization and wealth maximization. Please share with us the notes. I told you to make notes. That's why I want you to be in class and make notes. I'll share with you some slides Now, like these ones, I'll share with you some slides, but slides won't help you a lot because it's like a summary. So you should be able to be in class. When I'm explaining, you make some notes. Then when you get the slides, you compare with your notes, and that will help you to read better. And also, I told you to look through Pande. Pande is a big book. It's in the library. Anytime you pass by campus, you can pass by library. The library is open, and you borrow that book. Pande, it's a financial management book. It's a very elaborate book, but if you want a more summarized one, then you'll ask for Kakuru. How much does it cost? I don't know really how much, but it shouldn't be so expensive. So you should be able to buy it actually. You should be able to buy it also for your further reading, not necessarily just this, because I know some of you might pick some interest in finance, and so you can get that either Pande or Kakuru. Yes, but not. Yeah, these slides will be available, but not after this lecture. After I have completed them. Yeah, because if I give them now, you won't concentrate if you have the notes, and some of you have a tendency of getting notes and you don't attend. And these slides are just summaries. So when we are studying, hope you always with a pen and a book, trying to make your own notes. Any other question? Any question? If you don't ask me, I will ask you.
Good evening, sir. Well,
Good evening.
This is Joy Jerry BBC 2.
Yes, Joy.
On behalf of students who haven't attended this lecture, I'm pleading that you help me with the recording so that I send it to them on WhatsApp, because I was given host rights lately and I didn't record the whole lecture.
I didn't record also, but the e-learning always have these recordings, so you should be able to access them from the e-learning office.
Okay.
Or if you have a number of anyone from the e-learning, you should be able to get those recordings. Because I didn't record, I wasn't the host. So. Any other? All the lectures you have, not necessarily this one. Or whenever you want them, just contact e-learning. You can even email them. You get those recordings. You ask for them, you get them. They always record them for the purposes of. Any other question? People are not asking. Should I ask you? And then the other thing, try to use your names when you're writing, because the names you have now, like this one is called Bachelor of Business Computing too. That can't be your name. So now here I will not know that you attended my class. This because now this is you do business computing, so you understand these software things more than me. You should be able to know that the names you use here is what is taken now as the class attendance. We don't necessarily take attendance lists, but you all know that you have to attend 70% of your lectures. So people who use different funny names, you're not considered as you're attending lectures. So in case anything happens, you have a problem with your coursework or what, anything can happen and someone tells you never attended my class. So please always use your right name so that the attendance is taken. Because if you don't attend 70%, then you have no right of sitting for a paper. If you don't attend 75%, hope you know that. So hope as if there is no any question. GRST Joy, someone has recorded Gerard Nasasira.
Oh yeah, he has sent it to me already. Oh, yeah, okay. Yeah.
Okay then. So I hope there are no questions. Thank you very much for attending. Just be here in time next time, because this time I had given you some time. I knew you're going to come late, but the next time we are starting exactly 5:30. Thank you so much and have a good night.